JEPI, also known as JP Morgan Equity Income, is one of the latest ETF in the market. Its inception date is in May 2020. It seeks to deliver monthly distributions and the equity market exposure with less volatility. The managers of this fund have over 60 years of combined experience in investing. This defensive equity portfolio employs a time-tested bottom-up fundamental research process with stock selection based on proprietary risk-adjusted stock rankings. So the goals of the fund are very simple: seeking income while maintaining prospects for capital appreciation. But there's a very important question. Is it worth it? Let's find out. At the time of this recording, JEPI has a value of $54.80 per share. It has a dividend yield of 12.18%, which in individual holdings, this looks like a yield trap. This is not the case since this is an ETF. It currently has an expense ratio of 0.35%, which is high when we compare it to other funds. As of 2/15, JEPI holds 132 holdings. All of them are mostly recognizable companies, but let's go over the top 10. We have Progressive, AbbVie, MasterCard, Comcast, Visa, Bristol Myers, Hershey, Pepsi, US Bank Corp, and United Health Group. JEPI pays a monthly dividend, and it has done so since the inception of the fund. However, when we take a look at the values, they're a bit inconsistent, as in it does not follow a trend. So how does this ETF operate and makes money to pay its shareholders? First, it holds companies from the S&P 500 to reduce volatility. Also, most of the companies pays a dividend. Number 2, sell out of the money calls and collect premiums. This is their main source of capital appreciation. So, as mentioned in the beginning, reducing volatility with dividend-paying stocks while using options to create cash flow. That's how they are able to pay a dividend, and this is why the values are inconsistent, because it depends on the premiums and profits of the call. Now, there's a piece of information regarding this fund that investors tend to not read. JEPI does pay a monthly dividend, but it is taxed as ordinary income or capital gain. So let's say you make $40,000 in qualified dividends and you are a single taxpayer. You will pay 0% tax rate, assuming that this is your only income. Changing the narrative, let's say you make $40,000 in dividends from JEPI and you are single. You will be on the 12% tax rate. So this is something to keep in mind regarding taxation when buying this fund. Contact your tax planner so you can come up with the best solution for your individual situation. Moving on to the performance versus the S&P 500, since JEPI was created in 2020, there's not enough data to compare. So with the little information we have, let's see how the fund is doing. Short term, in the 1 and 3 month period is losing versus the market. In the 1 year is beating the market by around 7%, but year to date is down by 6%. So in my opinion regarding this ETF, well, it lacks market performance since inception. This makes it difficult to identify if this fund is a good holding long term. We will need to wait at least until 2030 for a better picture of comparison. The fund offers consistent monthly income despite its different values. Since there's not enough market data, I do not see the defensiveness that they state in their prospectus. Dividends being taxed as ordinary income is not good for me, especially if you buy it in a brokerage account. Maybe in an IRA or 401k, JEPI will do well. Overall, this is an ETF that I am not interested in buying as it lacks important performance data. Fees are a bit high, and the taxation is not the most efficient. It will be interesting to see how this will perform as more data rolls in. Now, there is another ETF that has proven to beat the market, pay a nice growing dividend, and it has enough data to back it up. It's SCHD, and I made a video about it, so go check it out and let me know what you think.